Hey everybody, welcome to Mortgage Today for Tuesday, January 16th, 2024, and oh, what a day it was. It was a Monday on a Tuesday. It's the first day of the bond market because yesterday we celebrated the life and times of Dr. Martin Luther King Jr. And this quote's a great one for the mortgage business today. If you can't fly, then run. If you can't run, then walk. If you can't walk, then crawl. But whatever you do, you have to keep moving forward. And that's what we have to do all this year to make it through into 2025. But on Tuesday, January 16th, it was a weird open on the MBS. The 6.0 was flat, but the 5.5 was down 30 basis points in like the first 45 minutes of trading. The 6.5 was down 9 basis points. Data on Friday reflected an unexpected decline in wholesale prices, giving investors hope that the Fed may consider rate cuts as early as March. The trading week was short and retail sales are due out on Wednesday. The upcoming week won't have much in way of market moving data. However, we get a whole bunch of Fed speak and housing data, while the NAHB Housing Market Index, housing starts and existing home sales, do come out. Regional Fed surveys usually don't mean much, but the New York Empire State Manufacturing Survey showed a brutal collapse, falling 29 points to negative 43.7, which is the lowest reading since May of 2020. If you remember, things weren't moving around that good back then. New orders and shipments fell dramatically while input prices rose slightly. As you can tell from the chart, however, this is one data point that is pointing to a harder landing than people are expecting. On the Citibank earnings conference call, CEO Jane Fraser noted that they are starting to see issues as lower FICO borrowers in terms of credit losses. Consumers currently have about $1 trillion in credit cards across the board, and they're carrying an average rate of 20.74%. I've been saying for a while that basically once job growth stalls a little bit, and especially earnings. Once earnings growth stalls, we are going to see a ton of problems in the credit card space. The most hotly anticipated calendar event to start the holiday shortened week was a Q&A with the Fed's Christopher Waller, hosted by the Brookings Institute. The questions were as solid as you would expect from David Wessel, and Weller's answers were informative, at least for market participants who may have understood his role in the current Fed canon. Specifically, Waller has been dovish in terms of impact on rates as of late. Today, his comments were hawkish, not because they were actually hawkish, but rather because they weren't as dovish as traders expected. So somebody that is expected to be in favor of lowering rates was actually more inclined to keep them the same. Rates reacted accordingly, with both MBS and Treasuries losing more than a small amount of ground. UMBS 6.0 closed the day down 9 basis points after being flat on the open. The 5.5 lost a big 45 basis points, so the market is now feeling that we are not dropping down into that range anytime soon. And then the 6.5 lost 17 basis points. So at the end of the day, when we look at it, ending at the 6.5 ended at the 6.0 ended at 101.2 late. So let's see where that puts us at on the chart. So the 101.28 is putting us right below that red 25-day moving average, which is converging upon that 101.392 Fibonacci that was a very strong floor and ceiling over the course of the last 2.5 weeks. We also got a post from our sponsor at wellthatmakesense.com. This is a post from the fantabulous book Traction by Gino Wickman, which is particularly important for the start of the year because it is all about setting your plans for where you want to be at the end of the year, how to break that up into quarters, months, weeks, and even meetings. This one is all about unlocking success, which is the power of vision. So check it out on our sponsor at wellthatmakesense.com.